Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. Our actions have moved our policy rate well into restrictive territory, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks.
Hello, family. Welcome back to another episode of Journey to Harmony. I'm your host, Richard Harmon. Today, I want to talk about the rate pause by the Federal Reserve and the signaling of rate cuts in the year to come. The Federal Reserve has been a part of the economic cycle the last 2 years, as they have risen rates from 8.25% all the way up to 5.5% to 5.75%. Over the last 5 years, we've seen a process of quantitative easing and how money has flown into the economy as a result of it from the time of the great financial crisis. That was placed on steroids during the pandemic, and rates have remained low up until the point where they started to raise rates. Everyone in the stock market has been waiting for the time when the Fed pivot, a reversal in their policy would happen. And it looks like now, after 3 straight Fed pauses, they are beginning to see a lesser downside in terms of the rates and the rate interest. I'm going to play another video here, watch a little bit of this, and we'll come back to talk about this after that.
In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. While participants do not view it as likely to be appropriate to raise interest rates further, neither do they want to take the possibility off the table. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of 2024, 3.6% at the end of 2025, and 2.9% at the end of 2026, still above the median longer-term rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals.
All right, perfect. So there you have it. The Federal Reserve, by their own admission, expect to have at least 100 basis point cut here in 2024. We additionally have a commercial real estate crisis that is currently in the mix. Additionally, with the Fed, with the federal debt and a lot of these other particular debts that are refinancing or coming due in this 2024, many people are believing that the cut will be even deeper than what is expected. With the announcement and with the expectation now that we are headed towards quantitative easing, there's most likely going to be a rush now, as everyone who is understanding of what the moment states are going to be rushing to get into things before the prices take off.
And for that, we go to Steve Leisman.
The Federal Reserve leaving interest rates unchanged at 5.25% to 5.5%, a unanimous decision in the December meeting. The Fed says growth has slowed from the strong third quarter pace, saying inflation has eased over the past year, but remains elevated. It is the first time they said anything positive about inflation for a very long time in the statement. And they backed off somewhat their bias to hike, saying it was now determining the extent of any additional policy firming, inserting the word any into the statement for the first time. They lowered their 2024 Fed funds outlook to 4.6% from 5.1%, so half a point down, forecasting on average for a Fed official 80 basis points of rate cuts next year. It had forecast just 50 basis points from a higher level. Of course, they got rid of the expectation for the forecast for an additional rate hike this year. That's gone.
Imagine if rates right now are dropped down to 5% or so, the housing market is going to be set on fire once more. So those who are wise, they see now that the peak is in, and we're headed now for a lower interest rate. Banks have had a wider spread over the last few years as they have created a buffer zone against the federal funds rate and their overall rate. Normally it's at 1.5 to 2%. It kept it at about 3%. We can expect that number to continue to drop in time to come. It's not crazy to see mortgage rates somewhere in the mid sixes to lower sixes, and then with buy downs you can get somewhere around 5% or even maybe in the fours depending on your lender. This is not investing advice or anything like that, but just an update on things to come. But again, with the presidential election, with all of these things, there's going to be a serious boom here to come in 2024. As we've seen in the past, once again, many of those who were retired came back into the market. If the stock market returns, I was looking at it earlier today, it has reached, I believe it's all-time high again at 4,700. If that continues and it continues to move forward, many of those who return to the market will go back into retirement. And as we saw during the pandemic with people who are retired and the labor market being in short order, shortages will continue to abound. And those who are in the market who have those particular skills will be the recipients of a bigger bag of collection as a result of it. This is set to be a really unbelievable and wild year. We'll see exactly how it turns out. What are your thoughts on this? Please comment below. Like, share, and subscribe. Thank you so much for joining. Have a good day.